Let me, okay, fine. So good afternoon again. I have a feeling that there is some confusion regarding today's date for class coinciding with a holiday. So anyway, we will create a recording and this will be available to all the students who are not in class. Okay, so I'm going to share my screen. Okay, Samriddhi, is this visible?
Yes, ma'am.
Okay. Samriddhi, please let me know around 2 to 3 minutes before the class is supposed to end so that I can wrap up for the students. Okay,
Okay,
so
ma'am.
first of all, students, your exams are around the corner just after a week, and the syllabus for the minor is going to be everything that we will complete today. Okay, so the next chapter is going to be on cash budgets for startups. We will not include that in your minor because I'm not sure whether we'll be able to finish the whole thing by next week. But everything else that we have done so far will all be a part of your minor. And your minor paper will be a mix of both theory and numericals. Also, I think Samriddhi has already sent you an email regarding how we will conduct your minor. So please go through that and you may get in touch with us in case of any doubts or questions. Samriddhi, you've already shared that email, right?
Yes, ma'am.
Okay, thanks. So if you recall, last time we had started off with a large case study, which was basically encompassing all that we have done so far, and we were towards the end of it. So please use this as a base for your group presentations as well. And of course, we will look at all of these aspects separately also during your exams. So we were at the end and we were discussing the financing cost implications associated with the need for additional funds. So the cost of obtaining additional funds may involve projected expenses such as additional interest expenses for borrowed AFN. Interest expenses show up directly on the projected income statement and in turn alter the AFN shown on the balance sheet. In contrast, added costs for equity sources of AFN need not involve projected expenses because much of the cost is in the form of a projected increase in the value of securities sold. If Game Toy obtains the $38,200 in AFN from additional equity investments, there is no adjustment to the projected financial statements. Naturally, because equity does not carry a fixed financial obligation with it. But however, please do realize that if you raise money through equity, it would mean a dilution in the holding for the founder. If the 38,200 is borrowed, the interest cost will eat into the firm's internally generated funds and increase the AFN. That is, Game Toy needs to borrow the initial AFN and any associated after-tax interest costs. Many ventures prepare second pass projected financial statements that incorporate additional financing costs. If Game Toy faces a 12% interest rate, it will incur about an incremental 4,600 or 0.12 into 38,200 interest expense to get the necessary AFN. So the second pass income statement would be like this. Second pass means after we have incorporated the financing costs. So it would be EBIT of 409,600 less interest, which will now have the added interest component of 4,600, that is 17,900, will give us an EBT of 391,700. Out of this, we take out the taxes at 40% of EBT, and it will give us a net income of $235,000. As a result of financing costs on the AFN, the net income and retained earnings will be only $235,000 instead of the first pass projection of $237,800. This $2,800 difference means that the AFN plug or balancing amount on the projected balance sheet needs to increase by $2,800 to a total of $41,000, which is nothing but $38,200 plus $2,800. Okay, so this is just to give you an idea as to what is the additional financing cost in case you decide to raise the money through interest. Okay, so this basically brings us to an end to the first part of the course. You may call it module 1 also, where we looked at basically what entrepreneurship is, and then we started off with projecting the balance sheet, P&L, and the cash flow statement. We also looked at calculation of the survival revenues and the effect that different costs have on it. And then, of course, we wrapped it up with a large case study that kind of encompassed the whole thing. So this would be, again, your syllabus for minor. And now we will begin with the next chapter, which is on the cash budgets for startups.
Ma'am, there are 2 students who have joined in.
Okay, Samriddhi. Okay, now just a second. Now over here, I have also put up again my material from Msl405, which was on cash flows. Okay, on managing cash flows for all of you. So you can go through that. Basically, gives the cash flow in a lot more detail, and this. Yes, this is again, we will go through creation of cash budgets for a startup through another caselet. Okay, so that it is absolutely clear to you with all the workings and everything. So I hope, Samriddhi, that this is visible.
Yes, ma'am.
Okay, thank you so much. So basically, for a startup, as all of you know, cash is the most vulnerable aspect. And even though a startup may seem to be making a profit, it could be running out of cash, as we saw in the first case study. So the startup needs to be very, very careful about its cash flows. And here, through an example of a startup, we would see how a company can make their cash budgets. Okay. So naturally, cash budgeting or cash flow management is a short-term planning tool, because you're looking at cash flows for a shorter time period or shorter horizon. Okay, and cash by itself is a current asset, so it has a short-term horizon to it, compared to plant, machinery, building, which have a long-term investment horizon. Okay. So Pamela, Dharma, and Constance, upon completing their undergrad degrees, decided to start their own venture. They were able to acquire exclusive North American distribution rights for a new type of interior wall paint product, which is called New Age paint, which emits a light fragrance when interior temperature changes and conveys a subtle color alteration as the mix of lighting changes from primarily solar to primarily incandescent as the day matures. One of several different fragrances can be embedded in the paint. Each fragrance has an expected useful life of 5 years with annual wipe down of a revitalizer. Pamela, Dharma, and Constance have formed the PDC company to own the distribution rights. The founders believe that they have a unique new product that can introduce a recurring revenue business model where none has previously existed. So I also think that they have a wonderful product. Students who have joined, in case you have any doubts, any questions, you may please ask. We've discussed the syllabus for minor, and I've stated all of that in the recording, so you can go through it as well. So PDC inventories New Age paint that it plans to sell shortly after having received the paint. It is currently March 31st, 2017, and the sales force has provided the following projected sales. So April sales are $115,000, May sales are $184,000, June is $138,000, July is $115,000, and August is $92,000. So we have these projections in terms of sales. Table 6.1 presents PTC's initial balance sheet. PTC is buying a used delivery truck on April 1st for $6,900 cash. PTC expects to pay miscellaneous cash expenses equal to 5% of the current sales and rent of $4,600 per month. and it records insurance expense at $460 per month, although it writes a check to the insurance company for a year at a time. So naturally it pays insurance in advance. PDC plans to draw the prepaid insurance account balance down to zero before cutting the next check to the insurance company. Depreciation expense is $1,150 per month, including the truck, and PDC anticipates a zero tax rate. Wages are paid twice a month with $5,750 per month, fixed, and 15% of sales, which are assumed to be uniform throughout a month, as a variable commission. Okay, so let me first give you the data and then we can come back to the balance sheet. Wages are paid a half month after they are earned. Now, please be very careful about the terms mentioned in the question, students, because we will be looking at how payments are either staggered or they are collected, and that would have an impact on the monthly cash inflow and outflow for your company, and that is a basis of drawing up a cash budget as well. As an example, the expected and realized sales of $92,000 for March are responsible for the 9,775, that is 0.5 into 5750 plus 0.5 into 15 days into 92,000 currently in the accrued wages account. PDC's inventory policy is to begin a month with sufficient inventory to cover 80% of the sales for the month plus a $46,000 cushion. Previous inventory balances have conformed to the current policy and sales forecasts have been accurate. The cost of goods sold amounts to 70% of sales. For example, sales are forecasted to be 115,000 in April. So the corresponding desired inventory level, that is end of March and beginning of April, is estimated as 64,400, which is nothing but 115,000 into 0.8 into 0.7, which is the COGS rate, plus 46,000, that is equal to 110,400. Okay, so you have to be very careful about this arithmetic as to how much is being paid in 1 month and how much is being staggered and so on. The beginning of month inventory amount, example for April, is also the inventory amount at the end of the prior month, that is, it is closing for March. The venture takes all deliveries on account and pays half in the current month and half in the following month. PDC's sales are 60% cash and 40% on accounts receivables collected in the following month. It has no currently overdue accounts and anticipates none in the near future. For example, 40% of the $92,000 sales made in March were credit sales and show up as 36,800 in accounts receivable on the balance sheet at the end of March. Now, PDC's only available credit line is from a founder who agreed, in return for a piece of the equity, to lend the company money at 1.5% interest per month for the next 2 years. The agreement with this founder stipulates a 23,000 minimum cash balance in the venture's checking account. PDC borrows from and repays the founder only at the end of the month. Interest is therefore the previous month's ending balance multiplied by 0.015 or 1.5%. Our goal is to project PDC's cash balance at the end of each of the next 4 months and to create a set of projected financial statements congruent to the projections. We break this daunting task into smaller pieces. Now, there are 2-3 ways in which you can create cash budgets, students. I would advise you to adopt this first way that we are talking about and use the second and third method just as verifications of the cash budgets. Okay, even though the second and third method may seem faster or quicker to you, but this is the way you should be creating a cash budget, because here you are able to look at each and every cost head separately. Okay, so this is strongly advisable, unless of course you become so adept at making cash budgets that you can make it directly from the statements. Okay, so task 1 is Samriddhi, because I'm not able to look at the students, in case anyone has a doubt or question, or they're raising their hands, or they put up something in the chat box, do let me know.
Yes, ma'am.
Thanks. So the first step here is budget PDC's cash and borrowing position for the next 4 months through July 31st. So the implementation plan is A, use the sales forecast to determine the monthly cash collections from the current month's cash sales and collections of receivables on the previous month's credit sales. B, use the inventory policy to determine the inventory expenses and schedule for their payments. C, schedule the wages payment according to the semi-monthly pay arrangements. D, put these items together with the other assumptions and determine cash needs before financing. And E, complete the cash budget by determining the necessary borrowing and repayment provisions, including interest payments, ensuring that $23,000 is available in the checking account. So table 6.2 presents each step of this plan for PDC. In part A, we first prepare a sales schedule for each month that includes the sales forecast and cash collections. Cash sales are collected in the month the sales occur. Credit sales are collected in the month after the sales occur. For example, in April, cash sales are expected to be 60% of $115,000 or $69,000. Accounts receivables of $36,800 at the end of March from the credit sales made during March are added to the $69,000 in expected April cash sales for total collections of $105,800 in April. Next, in part B of table 6.2, we prepare a purchases schedule for each month that includes estimating the amount of purchases and the payment or disbursement of funds to pay for the purchases. Okay. So before I show you 6.2, let us just glance through table 6.1. This is how the PDC's initial balance sheet looks like on 31st of March. You can see that they want an opening balance or closing balance of cash of 23,000. They have accounts receivables of 36,800. They have an inventory of 110,400. They have prepaid insurance of 4140, which is giving them a total current asset of $174,340. And they have fixed assets of property, plant, and equipment. The gross fixed assets are 85,100 less the accumulated depreciation of 29,440 gives us a net property, plant, and equipment of 55,660. Okay, so the total assets figure is $230,000. Then on the liabilities and equity side, they have accounts payable of 38,640 and they have accrued wages of 9,775, giving them a total current liability of 48,415 and owner's equity of $181,585. Again, everything adding up to a total of $230,000. If you have any doubts, any questions, you can please ask. So here you can see the detailed way in which we're trying to arrive at the figures. This is the sales schedule in part A, where we have put in the sales forecast for all of the months. And we have also said how much of this portion would be your credit sales and how much of this would be cash sales. Based on this, we prepare the schedule 2 of the sales, that is cash sales this month in April and whatever percent of last month's credit sales, it's 100% here that you're collecting. So this 36,800 which is credit sales in March is being collected in April. Okay. Similarly, credit sales in April is being collected in May and so on. So this is how we get to know the total collections for this month. Then in part B, we create the purchases schedule. Similarly, in purchases, we start with the ending inventory for each month. To this, we add the COGS, that is cost of goods sold, and we get the total needed inventory of 174,800. From this, we subtract the beginning inventory that we already had, and this will give us an idea of the inventory that we have actually purchased. Okay, and that is what we need to know. So for each month, we are able to calculate the purchases in this manner. Okay. Now for purchases, there is cash outflow definitely, but we see how the payments are made. Now basically the payments are made in the following way. We pay off 50% of last month's purchases, okay, and that is 77,280. Half of this would be paid off in the following month, and we also pay for 50% of this month's purchases. So half of 119,140 is paid off in this particular month. Okay, so we add up and we get the outflow that is there for each month's purchases in this manner. Similarly, we create the wages and commission schedule for each of the months. We have all the fixed wages which are constant through the months, and then we have commissions which are 15% of the current sales. So the sales are already given, so just calculate 15% of that and you get the sales commissions, and we add this and we come to the total wage bill for each of the months. Now in the schedule 6, we look at how we are actually paying these wages. So again, we are paying off 50% of last month's wages, and we are paying off 50% of this month's wages. So we are paying 50% of previous months and 50% of this month in the particular month. Okay, so for April we are paying 50% of April and 50% of March. The same schedule is. Yes, Samriti?
I think Aniket has a doubt. He has raised his hand.
Yes, Aniket?
Hello, ma'am.
Yes, Aniket, how are you?
Ma'am, fine.
हाँ बताओ.
In the purchases schedule,
Yes.
that inventory thing, ending inventory, cost of
हाँ
goods sold, and all.
हाँ
I have a doubt because the cost of goods sold in this, the goods, let's take there is 100 quantity of goods,
Hmm.
and it was sold at 64,400 rupees.
Mhm.
But the thing is that we will purchase that 100 goods at less cost, no? So how it is managed here?
No. Aniket, this cost of goods sold is not the price at which we are selling, Aniket.
Okay.
This
It is
cost of goods sold is the
we
cost
purchased
for the
only.
company. So
Okay.
suppose I have sold, say, 100 machines, okay, or 100 paints in this case, 100 tins of paint. Then I am not talking about the price of the paint. Naturally, the price
Okay.
would be cost plus profit, right?
Okay,
Over
ma'am.
here, we are only looking at the cost for whatever we have sold.
Okay.
Naturally, when we have sold off a certain item, and then that means that there would be at least some inventory remaining with us, right?
Yeah, I got it,
That
ma'am.
is what we are trying to calculate here कि भाई हमने net कितना purchase किया inventory का. And if you see, PDC is actually not making these paints, they are basically distributing these paints.
Yeah.
Okay, so are you now clear? Please don't
Yes, ma'am.
confuse cost of goods sold with the price at which we are selling. It's not the sales revenue.
Yes, ma'am.
If you
Thanks.
recall, Aniket, also just as another reminder, if you recall, sales revenue minus COGS gives you the gross profit. Remember?
Yes, ma'am.
This is the same COGS.
Okay.
ठीक है, Aniket?
Yes, ma'am. Thanks.
Okay. Samriddhi, just keep a tab, okay? Just note down the names of the students who are regular in the class.
Okay, ma'am.
Fine, because tomorrow when we are actually making up the grades, suppose I have to give some grace marks to students to just to pull up their grades, then I would like to do it for people who are regular in class, even though we don't have
Yes.
a very explicit attendance policy, because we can't have that due to COVID, but I would like to see the students who are there in class.
Okay, ma'am.
Okay, so students, please keep this in mind as well, and know that if you're regular in class, like Aniket is there, I don't see एक और student भी था, I don't remember. I don't know if Naman has been there constantly. I think Rupesh has been there in some classes. So Samriddhi, just see the attendance that way and just let me know. I mean, just keep recording it, okay?
Yes, ma'am.
ठीक है. So Aniket, I hope your question has been answered.
Yes, ma'am.
Great, great. So now coming to the wages schedule, as I was telling you, we are actually looking at the collections or the payments of 50% of last month's wages and 50% of the current month's wages. And that is how we calculate the wages for all of this. Now, as you can see, students, this is basic arithmetic. It is nothing very complicated. It's just that you need to remember how much of wages are being paid every month. इसमें पिछले महीने का कितना है, इस महीने का कितना है, and all that. So it's basically arithmetic. You have to be careful with the additions and subtractions. That's it. Now, based on these schedules that we have prepared, we can create a cash budget for PDC. Now, see, this is the format. Oh, I'm just open this. This is the format of the cash budget. Yeah. Okay. Now, see, we have to prepare it for 4 months: April, May, June, and July. We first start with the beginning cash balance, which the company desires, because that is what the founder wants it to do. Basically, the reason why they wanted to have some cash in hand is so that they are able to collect their interest payments as and when it comes due. Okay. So this is 23,000 for each of the months. Then we start with all the cash receipts. So all the cash receipts means all the collections that you have from customers. So in April you have 105,800, May you have 156,400, June you have 156,400, and July you have 124,200. You see, is there any other way that cash is coming into the business? No, typically in this business cash is only coming in from sales. Okay. So we add up all the cash receipts, and the total cash available for our needs before any financing is required is basically the addition of the beginning cash balance as well as the collection from or your sales. So we have 128,800, which is our total cash inflow from our operations. Okay. Then we look at all the cash disbursements, or how the cash is being spent. So we have merchandise, basically purchases, okay, of 98,210 in April, 111,090 in May, 93,380 in June, 75,670 in July. Then we have wages and commissions. Okay, so our basic expenditure heads are material, labor, okay, and you may have other miscellaneous expenses as well. So wages are 21,275 in April, 28,175 in May, 29,900 in June, and 24,725 in July. The miscellaneous expenses are 5,750 in April, 9,200 in May, 6,900 in June, and 5,750 in July. Now the company is also paying rent, which is a constant of 4,600 per month. So we have mentioned that. Then there is a truck that the company has purchased in April. So naturally cash has gone out for this. So it's 6,900 in April and 0 for the other months. So we look at all of the the expenses, and this is all. So the total disbursements that come out are 36,735. To this, we add the minimum cash balance that is desired or that should be there in the company, and we get the total cash that we need at 159,735. So basically, it's very simple. You add up all the inflows and you add up all the outflows. And now here we see that excess of total cash is actually negative, because we only have 128,800 and we need 159,735. So the difference is 30,935, which we need to finance from outside sources. Now this is so critical for a startup. If a startup does not have funds at this stage, then it will not be able to move into May at all, okay, because it is already short of cash in April. Now, naturally, financing would be required. In terms of financing, we are borrowing 30,935 to meet up the cash shortfall. We are not repaying anything now because we don't have the money. So we have a loan balance of 30,935. We are not paying any interest right now because we have just borrowed. And the total effect of financing again remains 30,935. and the cash balance with us remains 23,000. Okay. Similarly, for May, if you see, the total cash needed is 176,065 and the total cash that we have is 179,400. So we have a gain. We have a surplus here of 3,335. Now, out of this, we will pay, 464 as interest and the remaining as the principal amount, the repayment. Okay. So our loan balance that would remain would be 28,064, which is nothing but 30,935 minus 2,871 of repayments. Again, the total effect of financing is minus 3,335 and our cash balance remains at 23,000. Okay. Then we look at again for the month of June, we have the total cash needed of 157,780. We have more cash receipts at 179,400. So we have a surplus of 21,620. From this, a percentage is given as interest. Okay. Please remember that interest is always paid on the remaining loan balance. Okay. And of course, the balance goes towards the payment of the principal amount of the loan. So the loan balance that now remains is 6,865, and the total effect of financing is that we've again spent 21,620 to actually repay our loan, and our cash balance remains at 23,000. In the final month of July, our total cash needed is 133,745 and the total cash receipt is 147,200. We have a surplus of 13,455. We only have to pay off 6,865 of the loan amount plus the interest, and hence the total effect of financing has been minus 6,968. This means that we have a surplus of 13,445 minus this 6,968, which gets added to our cash balance to give us a more than desired cash amount of 29,487. So it is very simple. This is how you create a cash budget. Okay, basic arithmetic. Okay, fine. Now, the reader should be able to verify these amounts based on our earlier discussion of PDC's inventory policy. However, the process is probably worth repeating here. Now, this is just a description of this cash budget to kind of reinforce each and every aspect. First, forecast May's sales at $184,000. 80% of sales, or 147,200, is the target inventory coverage. Multiplying 147,200 by 0.7 converts sales into a COGS basis or cost basis of 103,040. Adding a safety stock cushion of $46,000 produces an ending inventory target for April of 149,040. Actual cost of goods sold for April is 80,500, which is nothing but 115,000 into 0.7. So adding 149,040 and 80,500 produces the total needed inventory of 229,540 for April. Subtracting the beginning inventory, that is the amount remaining from March, of 110,400 results in the need to purchase $119,140 of paint to meet April's ending inventory target. Purchases are made on account with net 15-day credit terms such that 50% of the purchases made in a specific month are paid in that month. The other 50% of a month's purchases are paid in the following month. To complete the purchases schedule, a purchases disbursement schedule must be completed. PDC pays the 38,640 in accounts payable existing at the end of March, that is $77,280 March cost of goods sold times 0.5, and also pays 59,570, which is this month's sales, that is 119,100 into 0.5 for the April purchases, for the total April disbursements for purchases of 98,210. In part C of table 6.2, we prepare a wages and commissions schedule, As previously discussed, fixed monthly wages are projected at 5,750 and PTC also pays commissions amounting to 15% of the current month's sales. Based on April's forecasted sales of $115,000, commissions are estimated at 17,250, which is 115,000 into 15%, for total wages and commissions of 23,000. That is fixed component plus this variable component. However, because there is a 1/2 month lag between when wages and commissions are earned and when they are paid, actual dollar disbursements are 50% of last month's wage and commission expenses and 50% of the current month's expenses. For April, 50% of March's wages and commissions were 9,775 and 50% of April's expenses were 11,500 for a total monthly disbursement of 21,275. The three internal operating schedules, that is sales schedule, purchases schedule and wages and commission schedule, now are used to prepare a fourth schedule indicating the flow of cash through a venture, which is nothing but the cash budget. So a cash budget shows a venture's projected cash receipts and disbursements over a forecast period. Cash budgets often are estimated monthly for up to a 1-year period. Part D of Table 6.2 illustrates a cash budget for PDC covering the period of April through July. Cash on hand from the March balance sheet is 23,000 and PDC wants to maintain this cash level in each of the forecast months. Projected cash receipts for April of 105,800, which is taken from the sales schedule, are added to the beginning cash for total cash of 128,500 before disbursements and financing. Total cash disbursements in April amount to 136,735, which reflects in part the sum of disbursements for purchases of 98,210 from the purchases schedule of 21,275 from the wages and commissions schedule. As noted earlier, miscellaneous cash expenses are forecasted at a 5% of the current month's sales or 5,750 for April, which is nothing but April sales into 5%. Rent was projected to be 4,600 per month and the 6,900 truck purchase was to be paid in cash in April. So total cash needed in April is 159,735. That is all the disbursements plus the desired level of cash that is required. Cash needed exceeds cash generated by 30,935, making it necessary to borrow 30,935 so that PDC can meet its target cash balance of 23,000. Cash receipts are projected to exceed cash disbursements, including the desired 23,000 cash balance, by 3,335 in May. This extra cash will be used to pay the interest of 464, which is nothing but 1.5% of the balance, and loan repayments of 2,871. By the end of July, the loan will be repaid in full and PDC will have an ending cash balance of 29,487, which is 6,487 greater than the target ending cash balance of 23,000. So basically it's in the end of July that the company is going to start churning extra cash, which will actually get added to the basic cash that is required. Preparing monthly cash budgets for a full year allows the entrepreneur to address the following questions. 1. Is there a cash need for the coming year? 2. If so, when will that need arrive and what is the maximum amount required? And third, can a cash need, if any, be repaid within the year? So these are very crucial questions for a startup, especially in the survival phase or even in the beginning of the rapid growth phase. And the cash budget helps you nab these answers. We prepared a 4-month cash budget for PDC company. its maximum cash need of 30,935 arrived in April. The need for financing to cover it lasted only for a few months, with scheduled retirement of all new financing by July. In many, if not most cases, the retirement of new financing will only be evident with additional months of financial projections. Okay. So this, as I was telling you students, is the best way and the easiest. I think it is laborious, but it is one of the most clear ways of preparing a cash budget. So when we give you questions on cash budgets, please prepare it through this method. Okay. Now let us look at the alternate routes in which you can prepare the cash budget. So we can also make it through the projected monthly financial statements. Another common way to express the venture's anticipated cash needs is to project the balance sheet and income statement into the future and produce a statement of cash flows. This is easiest to do when we have already calculated the interest expenses for the 4 months. So let us see how we do this. First, we prepare PDC's pro forma income statement for the 4 months. So use the summaries of the revenue and expense items to create 4 months of income statements that include the interest expenses determined in task 1. So as you can see, we have to calculate the interest and then create this. So the first method is the most step-by-step method that you can get. Then you prepare PDC's pro forma balance sheet for July 31st. And then the following steps are required. A, adjust the initial balance sheet excluding the cash account for each of the 4 months of changes. B, make sure that the equity account reflects each month's net income. C, calculate the cash account balance which is consistent with total assets is equal to total liabilities plus equity. And D, verify that the resulting cash account balance agrees with that from the cash budget. So let us see how we can do this. Prepare PDC statement of cash flows for the 4-month period. That will be the final step. Okay. Now all of you know, remember how we can calculate and project financial statements. You've already done that in the previous chapters. And you have also done how we can create cash flow statements after that. Okay. So apply the cash flow from operations, investing activities and financing activities to the data for PDC and verify that the resulting ending cash flow agrees with the cash budget and the cash account balance on the pro forma balance sheet. So first let us see the projected statements of the income, okay, and then we look at the balance sheets and then we'll come to the cash flow statement. Okay, so this is the projected income statements for PDC for the 5 months. Sales 92,000 less cost of goods sold of 64,400 in March. We had the gross margin or gross profit of 27,600. From this, we took out all the operating expenses, that is wages and commissions of 19,550, rent of 4,600, miscellaneous expenses of 4,600, insurance of 460, depreciation of 1150, and we got a negative total operating expenses of minus 30,360. So hence we made a loss from our operations and the loss is minus 2760 or the negative profit of 2760. There is no interest expense in March and the net income is minus 2760. Similarly, we make the projections for April, May, June and July. Okay. Then we make the projected balance sheet. So as you can see students, this is a more cumbersome process. The first step is very direct and very simple and accurate, and again I would reiterate that that is the best way to go. Now the projected balance sheets are, we start with the current assets. Say in March we have cash of 23,000, then we have accounts receivables of 36,800, we have inventory of 110,400, we have prepaid insurance of 4,140, gives us a total current assets of 174,340. To this we add the fixed assets of equipment, fixtures and other fixed assets. The gross is 85,100. less the accumulated depreciation is minus 29,440, which gives us a net property, plant and equipment of 55,660. The total assets now become $230,000, which is the fixed assets plus the current assets. Now we start with the liability side, the current liabilities. Accounts payables are 38,640. Accrued wages and commissions payable are 9,775. There is no loan. The total current liabilities is 48,415. The owner's equity is 181,585. And the total liabilities and equity is $230,000. So similarly, we make the projections for the other months of the balance sheet as well. And third, we create the cash flows. Okay. So table 6.5 will present the statement of cash flows. Cash flows from operations are projected to be minus 24,035 in April. This amount coupled with cash flow, so let us see the cash flow statement. This is it. If you recall, we had already done this in the previous chapters. So we can start like this also. So let me just give you the data and then we will see the final statement of cash flows. Okay. So initially when we started off, we had an operating cash outflow of 24,035 in April. And this amount was coupled with cash flows from investing activities of 6,900, basically the purchase of the truck, which produced a total cash shortage of 30,935 before financing activities in April. However, the required loan of 30,935 in April is projected to be paid off in full by July. In addition to repaying the loan, PDC will accumulate $6,487 in surplus cash beyond the target balance of $23,000. As a result of this exercise, you should be convinced of the following. Indirectly projecting cash balances or deficits through pro forma balance sheets and income statements and then using a statement of cash flows gives the same answer as direct calculations of receipts and disbursements, as long as you have included the correct amount of interest expense. In fact, the adjustments made in the cash flow statement are exactly those necessary to calculate the net impact on the cash account. Delays in receipts and disbursements from the associated accounting revenues and expenses are incorporated through changes in the associated accounts in the cash flow statement. To finalize this insight, try the fastest method of communicating cash projections. So even though they say that this is the fastest way to communicate what is the cash required, but I would still suggest that because you are starting off with creating cash budgets, and also if you're an entrepreneur, it is very important that you have the each cost heads mentioned, given there. Okay, so let us see how the projected statement of cash flows are done. So cash flows from activities for the 4 months, we have a net income of minus 460, that is net profit of minus 460 in April. The adjustments that are done to the net income for cash flows, we always add back the depreciation because it's a non-cash flow statement. Any increases in accounts receivables, we subtract. So here we can see that the accounts receivables have actually decreased, so that is minus 9,200. Any increase in inventory we subtract, that is 38,640. Any increase in prepaid insurance we subtract, that is 460. Plus we add any increase in accounts payable. So basically any increase in liabilities is a source of finance, so you add that, so there's a plus sign here. Plus any increase in accrued liabilities is added back. The total adjustments, that is the addition of all of this, gives us minus $23,575 from cash flows. So the net cash flow from operation is minus 24,035. That is this minus 23,575 added to the loss that we have incurred. Now let us look at the investing cash flows. We have one capex of 6,900 in April, that is the purchase of the truck. So again, this is an outflow. So this is minus 6,900. From financing, we don't have any equity issue. We don't have any dividends that we have paid. But yes, we have taken a loan, and that is of 30,935. So when we have taken 30,935 as loan, it has cancelled the amount that is required by us, and so the net change is cash is 0. The beginning cash balance has been 23,000, and this becomes the ending cash balance as well, because our operations, financing and investing have not yielded a net cash flow to the company. Then similarly for May, we start with a net income of 5,976. We add the depreciation, we subtract any increase in accounts receivables, we subtract any increase in inventories, we subtract any increase in prepaid insurance. We add any increase in liabilities like accounts payable and accrued liabilities. We add all of this up, we get a total net cash flow from operation of 2,871, which is nothing but minus 3,105 plus 5,976. We don't have any investing cash flow, that is 0. If from financing, we don't have any equity, we don't have any dividends payments, but we have paid money for the loan that we had taken, so that is minus 2,871. Okay, this again cancels out the amount that was falling short. Basically, all the cash flow from operations have been used to retire our debt. Hence, there is no net change in cash, and we again end up with the same cash balance. Okay. Similarly, you do this for the other 2 months also. Now, a lot of people feel that this is the easier way to go ahead, because just by the cash flow, you are anyway making the cash flow. So just from the cash flow, you are able to get your cash projections also. But again, I would suggest that the first method is better, because you would be able to then tell us exactly where the cash requirements are there. Okay. Cash planning from a projected monthly balance sheet. Now in this, you can just take up spreadsheet and calculate the change in cash account balance in a spreadsheet that uses only the beginning and ending balance sheets and net income. So in this, it is very easy. Again, it's a shortcut. I would advise you against it. You create a spreadsheet with the balance sheets for March 31st and July 31st as columns. B, bring the difference of the values in the columns and adjust the sign to reflect the change in cash flow, placing these sign differences in a third column. And C, add the values in the third column to calculate the changes in PDC's cash position directly. So let us see how this is done in table 6.6. Okay, so you see here, we have the March balance sheet and we have the July balance sheet. Just put it up in columns, okay, in a spreadsheet. We start with our current assets. We had total current assets, we had plant equipment, then we had total assets, then we had current liabilities, then we added the long-term liabilities, and we had the total equity. Okay, so when you compare these two figures, leave the cash balance, the cash account separately. Accounts receivables, you can see, has increased from 36,800 to 46,000 in July. So this means that we have used up 9,200 of cash. In inventory, you can see that the inventory is actually reduced from 110,400 to 97,520. So this means we have actually released 12,880 of cash. Prepaid insurance has also come down from 4,140 to 2,300, which means that we have again released 1,840 of cash. Basically, any increase in current assets shows that we have used up cash. Any decrease shows up that we have freed up cash. Then when you look at the fixed assets, then they have actually increased by 6,900, which shows that we have bought that truck. So this is the use of cash. Then when we look at accumulated depreciation, that has also increased. Now depreciation is a source of cash because we are actually not paying anyone. That money is lying with us. Then when we look at current liabilities, we see that the accounts payable have actually reduced. So this means that we have used up cash, we have paid off. So this is minus 4830. The account accrued wages and commissions payables have increased. So this is a source of cash of 1725. There is no net loan. Okay, so it's 0. So when we add all of this up, we find that we get a total balance sheet cash impact of 115, and the net income minus dividends was 6,372. So the total 4-month cash flow has been a positive 6,487. Now this is a very, very shortcut way of projecting cash. Okay, and a lot of people do this. They have ready-made spreadsheets and they just use this to project what is the cash requirement that they will have. Okay, so when projecting a venture forward into the future, there are several ways to complete the exercise. If the planner is not particularly concerned with maintaining a strategic level of cash, he or she can let the cash account take up the slack to balance the balance sheets. If the venture has overspent, the balance will be negative at an amount representing the minimum level of cash necessary to function according to projections. That is excluding financing costs on the funds used to offset the negative balance. Now this balancing cash must come from somewhere, and the cash balance should not really be thought of as negative unless perhaps the plan is to overdraw the venture's checking account. If the venture must strategically hold a certain amount of cash, it is better to project the cash account to contain that strategic amount of cash and then formally modify an existing or add a new liability to provide the balancing cash flow, that is including the financing expense. If the planner balances by increasing the liability and the cash, he should not forget that the increase in the liability is not usually a done deal. Most early stage ventures have serious difficulties locating debt arrangements. Okay, so these were the 3 methods that you could use to project the cash that the company would need in the initial months. Out of these, the first method is the most detailed and it looks at each cost head, and that is what is recommended for startups. Okay, however, the second and third methods are used as verification of your numbers. So this is the cash budget. Any doubt, any questions so far? Which method do you think seemed the easiest to you? Anyone? Aniket, Naman, दो ही है यहाँ पे.
The first one.
First one ना अनिकेत?
Yes, ma'am.
उसमें कम से कम हर हेड अच्छे से दिया हुआ है and you can just do the calculations and you can see कि भाई किस हेड में आपको कितने पैसे की और जरूरत हो रही है, right? So I would also suggest that as entrepreneurs you follow the first method because that will help you manage your company better. Of course, the second method, third method are good as verification tools. Some people use it as a shortcut to just tell कि भाई end में कितना cash होगा हमारे पास. But I think the first method is most detailed. Okay. Okay. Thanks, Aniket. Now we come to some very interesting ratios which are called conversion period ratios. Basically, these ratios show us the relationship of the operating cycle of the startup. Okay, how efficient the startup is in managing its operations. So conversion period ratios measure the average time in days required for non-cash current assets and selected current liabilities to create or demand cash. The faster assets can be converted into cash, the greater is the venture's liquidity, other things being equal. Of course, the faster liabilities transform into cash demands, the less liquid the venture is. So this you can see is the operating cycle of a venture. We start with cash. From this, we buy all the materials. We deploy labor on it and we get work in progress inventory, and then we come to the finished goods inventory. Now, if you're lucky, you're able to sell this finished goods directly for cash and generate cash immediately. But as I told you, 95% of business transactions are B2B, where you actually sell on credit. So you create debtors and then you collect from these debtors and then cash is generated. So since this is a cycle, the cash to cash cycle or the cash conversion cycle, or the C3 also, it's also called cash to cash or C3 cycle, then in that case, the faster this cycle will move, the more liquid your venture will be, the more profitable your venture would be, and so on. So we are looking at some operating cycle ratios, which will basically tell us how quickly the company is able to move from one aspect to the other in the operating cycle. So all of this comes together in a venture's operating cycle, which measures the time it takes to purchase raw materials, assemble a product, book the sale, and collect on it. The operating cycle for a simple manufacturing venture is shown here, figure 6.3. The cash conversion cycle, or C3, is the amount of time taken to buy materials and produce a finished good. That is the inventory to sale conversion period, plus the time needed to collect sales made on credit, that is the sale to cash conversion period, minus the time taken to pay suppliers for purchases on credit. So the first is how much time do you take to convert cash into your finished goods, how much time do you take to collect from your receivables to cash, and minus how much time do you take to delay payments or make payments to your creditors, who are basically people who are supplying you material on credit. So we look at another example called medical products company. Okay, and we take their balance sheet and income statements, and then we'll calculate the ratios from there. So the medical products company, or MPC, they have an income statement for 2 years, 2015 and 16, as follows. We have net sales of $438,000 less COGS of $285,000, giving us a gross profit of $153,000. From this, we take out the admin expenses of $45,000, the marketing expenses of $32,000, the R&D expenses of $20,000, and the depreciation of $14,000, giving us an EBIT of $42,000. From this, we deduct the interest expense of $12,000. We get the EBT, or income before taxes, of $30,000. From this, we deduct taxes at the rate of 30%, and we get our net profit, or EAT, at $21,000. Similarly, the figures are given for 2016 as well. Then you are given the balance sheet for the company for 3 years, 2014, 15, and 16. In assets, we start from our current assets. We have cash and marketable securities of $10,000, receivables of $60,000, inventories of $70,000, giving us total current assets of $140,000. We have gross plant and equipment of $205,000, and from this we take out the accumulated depreciation of $28,000 to get net plant and equipment of $177,000, which gives us a total asset value of $317,000. Then when we look at the liabilities and equity side, we have payables of $47,000, short-term bank loan of $40,000, accrued liabilities of $8,000, giving us a total current liability bill of $95,000. To this, we add the long-term liabilities of long-term debt and owner's equity to give us a total liabilities and equity figure of $317,000. Similarly, the data is populated for 2015 and 2016. So if we have all this data given to us, how do we calculate the ratios? First, we look at the inventory to sale conversion period. When a venture can decrease the amount of time between cash outlay for materials and labor and the production of a saleable good, few dollars get tied up in production costs. With continuing production, there will always be materials in inventory. The cost of inventories is the cost of doing business. For example, if the venture keeps average materials and work in progress inventories of $175,000, this is $175,000 that must be financed and cannot be used elsewhere. So you're tying up cash. The cash tied up in these inventories is a dead weight cost of doing business. Decreasing this cost allows the cash to be utilized elsewhere or paid back to creditors and investors. And that is why, students, you must have heard of inventory management techniques like JIT, just in time, where companies are just not maintaining any inventory and they are asking for materials to be delivered to the shop floor exactly when it is required, so that they are not holding on to any inventory. The inventory to sale conversion period is calculated by dividing average inventories by the venture's average daily COGS. The rationale for this measure is that when materials are purchased and labor is contributed, the associated costs are booked into the cost of inventories. When the products are completed and sold, the associated labor and materials costs are subtracted from the inventory balance and added to the COGS. If the cost of goods sold for an average day's sales is $100 and we have $5,000 in inventories, we say that the venture has 50 days of COGS sold in inventory. Put differently, the next dollar put into inventories won't be subtracted from inventories and added to COGS until 50 days from now. So if we have an inventory conversion ratio of 50, it means that we are taking 50 days to convert our inventory into a saleable product. Okay. So as we mentioned before, the average of the beginning and ending levels usually provides a more stable measure for a rapidly growing enterprise. Whenever we calculate any ratios, and we'll be doing ratios in greater detail in the next chapter, we always try and take average figures wherever possible. So ideally, you should be able to take a daily average if you have the daily data, or monthly averages. But typically, we don't have access to this amount of data. So what we can do is, if we have opening balance and closing balance, we can add the two and divide it by 2 to get the average inventories. Okay. So for MPC in 2016, the inventory to sale conversion period was average inventories upon COGS divided by 365. That is the average daily COGS. Okay. So average inventory is opening inventory plus closing inventory divided by 2. And the average daily COGS is the annual COGS divided by 365. So, and when we do this calculation, it comes out to 112.9 days or 113 days. So in 2016, it took an average of almost 113 days for MPC to convert the purchase of materials into a sale of finished goods. Ideally, MPC and other ventures want to have the shortest possible inventory to sale conversion period given the characteristics of the products. Production time depends on the complexity of the product and the automation used in assembly, among other things. Each venture must balance the trade-offs between faster production, the quality of production, and the amount spent to automate the process. Sales often depend on having products on hand when customers want them. Each venture, therefore, has to determine how inventory investment is split among the various levels of raw materials, work in progress, and finished goods. Okay, so this is the first, which is called inventory conversion or inventory to sale conversion period. Then we have the sale to cash conversion period, which is basically the collection of the credit sales. Okay. So the sale to cash conversion period measures the average days of sales committed to the extension of trade credit or your debtors or your receivables. Cash sales impose the least financial burden on a venture because the immediate receipt minimizes the time gap between the sales inflow and the previous outflow from product, materials, and labor. Of course, it is unlikely that a venture will be able to have all sales paid in cash. If, for instance, competitors extend credit, the venture will find it difficult not to follow suit. The vast majority of ventures will have accounts receivables. So the sale to cash conversion period or accounts receivables collection period, it is also called debtors collection period, is calculated by dividing the average receivables by the net sales per day. The rationale for this measure is that when a sale is booked as revenue, it is done so at the sales price, which is cost plus profit. Consequently, if the sale is on credit, the accounts receivable entry will be at the sales price. If we divide the accounts receivable balance by an average day's sales, we have a good idea of how many days of sales are being supported by trade credit. So for MPC in 2016, the sale to cash conversion period can be calculated as average receivables upon net sales divided by 365, or daily net sales. So average receivables, we have the opening and closing figures. So that is opening plus closing divided by 2, or the 2 years figures divided by 2, divided by the net sales per day. That is 575,000 divided by 365, which gives us 57.1 days, or nearly 2 months. Analysts may refer to this calculation as the days of sales outstanding, or the average collection period. MPC takes on an average 57 days to collect its credit sales. These 57 days, when added to the 113 days needed on average to convert inventories into sales, produces an average operating cycle of 170 days, which is nearly 6 months. So till 6 months, this company is not able to get cash. Then we have the third ratio, which is called purchase to payment conversion period. This is basically the time that the company can take to make payments to its creditors. Okay. Naturally, the longer it can afford to delay payments, the better it is for the company. The purchase to payment conversion period measures the average time from a purchase of materials and labor to actual cash payment. The ability to delay payment is analogous to borrowing money from suppliers and employees, and therefore decreases the need for external financing. It is usually considered safe to pay a venture's bills on the last day of the credit period. Many entrepreneurs have found it easier to stretch their credit periods, formally or informally, rather than arrange for alternative funding. However, the venture must balance the exploitation of trade credits with the cost and consequences of damaging relationships with suppliers and employees and violating relevant ethical norms. So yes, you should try and delay it, but not at the cost of relationships with your suppliers and employees. The purchase to payment conversion period is calculated by dividing the sum of average payables and operations related accrued liabilities by the venture's cost of goods sold per day. For MPC in 2016, the purchase to payment conversion period was average payables plus average accrued liabilities divided by COGS divided by 365, that is daily COGS. So average payables, again you take the 2 years figures divided by 2 plus average accrued liabilities, the opening closing divided by 2, upon 380,000 of COGS divided by 365. This comes out to be 76.8 days. Thus, MPC had almost 77 days of the cost of production financed by trade credit and accrued wages and liabilities. So this was basically indirectly financed through its suppliers and employees. Now we come to the final calculation, that is cash conversion cycle. The cash conversion cycle, also called C3, indicates the average time it takes a venture to complete its operating cycle, less a deduction for the days supported by trade credit and delayed payroll financing. It is a number of days of operation that must be externally financed. It also represents the time from a dollar outlay on raw materials to a dollar receipt on sales, because it includes the delay in the payment of the dollar through the purchase to payment delay and the delay in receipt through the sale to cash delay. As a target, the typical venture should try to keep its C3 as close to zero as possible. This would indicate that the production was fully internally financed. The typical venture, however, will not accomplish financing neutral operations. The cash tied up in inventory and receivables will almost always exceed the cash supplied by creditors and accrued liabilities. Okay. So how do you calculate C3? One calculates a C3 by adding the inventory to sale conversion period to the sale to cash conversion period and subtracting the purchase to payment conversion period from that. So for 2016, the MPC C3 was the inventory to sale conversion period plus sale to cash conversion period minus purchase to payment conversion period. which was 112.9 days plus 57.1 days minus 76.8 days, that is equal to 93.2 days. Thus, it takes 93 days on an average for MPC to complete its C3, that is 3 months. To produce and sell its inventories take an average of 113 days plus another 57 days to collect receipts on sales and arrive at the average operating cycle of 170 days. However, because MPC's suppliers and employees support an average 77 days through voluntary or involuntary credit, the C3 is reduced to 93 days. One very interesting fact from real life is that when you have large companies like Reliance and all that have a lot of clout in the market, you actually find them having negative C3s, okay, because the amount of time that they take to make their product and to collect it from their customers, more credit period is allowed to them by their suppliers. So for example, Reliance collects on an average in 2 weeks from its customers, but it pays its suppliers anywhere between 3 to 6 months. Okay, so these large companies are able to actually carry on their operations with a lot of help from their suppliers. Now, interpreting the changes in conversion times. So table 6.9 shows MPC's conversion period ratio performance for 2015 and 16. The inventory to sale conversion period increased by almost 9 days between 2015 and 16. The time required to produce finished goods could have increased due to production bottlenecks. So you have to see why have the operations become more inefficient or sluggish. So there could have been skilled labor shortages, material order delays, quality problems, or MPC may have carried finished goods inventories for longer time periods. A change in the venture's product mix towards more complex and time-consuming products could also account for the longer inventory conversion period. So ratio analysis rarely provides answers. They suggest questions that need answers. While it is normal for inventories to increase with sales, inventories that increase more rapidly than sales saddle the venture with the need for additional financial capital. For example, the average inventories account balance was 82,500 in 2015 and 117,500 in 2016. This represents an increase of 42.4%. At the same time, the venture's COGS increased by just 33.3%. If the inventories account had increased by the same rate as COGS, the inventories account balance would have only been $110,000. Okay, so these are the different, the conversion ratios for the 2 years. As you can see, the inventory to sale ratio has increased by 7.2 days, which actually lengthens your C3. The sale to cash has also increased, but marginally by 0.8 days. The purchase to payment has also increased, but by just 0.7 days. So the net cash conversion cycle has actually increased by nearly 9 days. Okay, so this is leading to a longer C3, an indication of inefficiencies in production. This breakout allows us to separate the actual change in average inventories account balance into the portion due to a change in COGS and the portion due to a longer inventory to sale conversion period. So actual 2016 average inventories has been 117,500. Forecast based on COGS has been minus 110,000. This equals an amount due to longer conversion period of 7,500. We also could have seen the impact of longer inventory to sale conversion period by using the inventory to sale conversion period formula. Here we use the daily COGS information for 2016, but solve for what the average inventories account balance would have been had the conversion period remained at 105.7 days. So this is done as follows. We have inventory to sale conversion period of average inventories upon COGS divided by 365. So this we can rearrange to get the average inventories. If the inventory to sale conversion period was at 105.7, into COGS divided by 365, that is 1041. So from this we can get the average inventories of $110,000 as well. So students, similarly we can also give you questions where we give you a ratio and we give you one or the other numerical, either the numerator or denominator, and we ask you to calculate the missing piece. Okay, so we can do a reverse calculation as well. The result is that MPC, even after correcting for growth, is carrying an extra 7,500 in inventories in 2016. At a financing cost of say 10%, this is an extra $750 of lost profit before taxes. Table 6.9 shows that the sale to cash conversion period increased slightly by 0.8 days between 2015 and 16. This indicates slightly lower average payment practices by MPC's customers. Even though this is a small change, some ongoing monitoring of the sale to cash conversion period would be in order to assure that future increases do not go unnoticed and that remedial action, if appropriate, is taken. The purchase to payment conversion period shows a decrease of slightly less than 1 day and increases MPC's C3, other things being equal. MPC has most likely been slightly increasing the speed at which it pays suppliers. Faster payment to support suppliers means a longer C3, other things being equal. Payables credit is particularly an important source of financial capital for growing ventures, and securing longer credit terms is an added benefit that frequently justifies the cost of searching. An analysis of changes in receivables and payables could have been conducted in the same way that we analyze the impact of a change in the inventory to sale conversion period. So overall, the C3 has increased by almost 9 days. The result is an increased burden on external financing. As we have seen, the primary reason for the increase was a longer inventory to sale conversion period. And now we will turn our attention to see how MPCs acquired external financing. So we will not do that, we'll stop here. So here you could see that not just did we do the cash budgets, we understood where the cash is coming in and cash is flowing out, but we looked at the operating cycle and we saw how much time does a company take to actually build its saleable product, then how much time does it take to collect on its credit sales, and then of course how much time does it take to pay off its suppliers, and from that we calculated the cash conversion cycle. Okay, so we do have a few numericals on this. Most of the numericals will either be based on these ratios or we can do some cash budget numericals also. But naturally in the exam we may not give you the complete cash budget because you may take half an hour just to make a cash budget. So we can give you smaller portions of the cash budget as well. Okay, so we'll do some numericals in the next class, and after that we will move on to the next chapter. Okay, Aniket, since you're the only one left, so I'm telling you.
Yes, okay.
Do you have any doubts, any questions?
No, ma'am.
ठीक है, ठीक है. So Samriddhi, I think we can stop the class today here, and in the next class we'll begin with the numericals and then we can move on to the next chapter. Okay,
ma'am.
okay. Thank you so much, Samriddhi. Thanks, Aniket. Take care. Bye bye.